Hello folks, Charlie Gipple here with CG Financial Group. Life insurance does not have to be so dang difficult. The other day I was talking to a wholesaler. He was talking about his whole life product and talking about PUARs, and then at a certain age we're going to do RPUs, and then from there on we're going to do PPVs, pay from policy values. I was like, holy crap, I get the acronyms, but slow down. I'm not getting them at a fast rate of speed. I don't even know what you're talking about. So I want to simplify some things today, specifically in the area of paid up additions riders. Now, before I go there, I want to talk about the differences between IUL and whole life insurance. A lot of folks have asked me this lately. I did a webinar with a few hundred people on it a couple weeks ago. By the way, we're redoing that webinar next week. We're going to do a repeat of it because a lot of people did like it. Even though the title was IUL versus whole life insurance, it's not really a versus thing. It is which product works best for which situation and which clients. And that is what I firmly believe. Why? Because they're just two different flavors of pie where we have the same ingredients that we're working with in order to cook it, right? What are the ingredients to both these pies, whether it's IUL or whole life insurance? Well, the first ingredient is you have an insurance carrier, and that insurance carrier has overhead. That insurance carrier has mortality expenses every year, right? Because they're offering life insurance. And those insurance companies, by the way, have general account yields that do not veer much from one another, anywhere from 4.2% today up to maybe 5.5%. But in addition to that, those insurance companies have shareholders. Those shareholders expect a certain amount of return on their money, whether it's 8% or 13% IRRs. You know, it's a fairly narrow bandwidth. Otherwise, capitalism and efficient markets are going to run those carriers out of business. Why? Because if the carrier shareholders are asking for too much, then what's going to happen is it's probably a crappy product and the clients won't buy those products. So again, the same ingredients here. You have the same insurance agents for the most part, the same insurance agents that are asking for similar amounts of commission, because if one gets out of line with the other, well, wherever the best commission is, that's probably what's going to be sold the most. And the same to the consumer. Whatever the best product is with the most value, that's what's going to be sold. And by the way, whole life insurance or IUL, they're both governed by the same tax code, right? TEFRA, DEFRA, TAMRA. It's just a matter of how the value in the policy is calculated. And that's the only difference between IUL and whole life insurance. And I know that's easier said than done. That's the only difference. There are a lot of differences, right? But in the end, we're dealing with the same ingredients here. It's just there are different ways to skin the cat. And paid up additions riders is kind of a different way of skinning the IUL increasing death benefit cat. Let me explain. Now, before I go there, let's talk about whole life insurance. You know, in my book, there are two different parts to the definition of whole life insurance. And this is probably not official. This may be way off. And if my definition is way off, then so be it. I'll make up a new definition here. Now, the first definition of whole life insurance is quite simply that the client has coverage, death benefit coverage for their whole life. Well, what the heck is a whole life? What's a whole life for one client is different than the other. Well, today, for the most part, a whole life is to age 120 with most insurance policies, right? Age 120 is the maturity age. Used to be age 100 when life expectancies and mortality tables were less than what they are today. But today, for the most part, it's age 120. Now, to me, the most important part of the definition of whole life insurance is the second part. Why? Because I have kind of an actuarial mind, and this one is the most actuarially significant, I guess you would say. Because a lot of the other benefits and features in the product revolve around the fact that, the second part of the definition, the fact that whole life insurance guarantees that the cash value at the maturity age will equal the death benefit. Whole life insurance guarantees endowment at the maturity age. Why do I say that's actuarially significant? Because think about that. Think about that. Think of if the premiums were not mandated to be a certain level, because premiums are not mandated with IUL, right? They are with whole life insurance. Why are they mandated? Because the insurance carrier has this guarantee. We, the insurance carrier, will guarantee you this, Mrs. Client, but in order to get that, you have to pay this premium here, right? So that's very, very actuarially significant to the rest of the structure of the whole life policy. Now, does the fact that the death benefit goes out to age 120, does that mean that's how far the premiums go out? No, it depends on the product. It depends on which company is offering the product. It depends on within that product how the actuaries calculated it. You know, my favorite product is a pay to age 90. And based off of a premium stream coming in until age 90, based off the guarantees in the policy, based off the cost of insurance charges, based off the guaranteed maximum administrative charges, well, based off all that, that's what the insurance company guarantees the client, right? There are some other policies out there that are maybe paid to age 65, right? So it's a bigger premium paid in a more compressed fashion. There may be some 10-pay products out there. Now, let me ask you a question as we get into the paid up additions rider. All else being equal, what is the best way, the fastest way, the most effective way of cramming as much cash value into the policy as possible? So when you think of payment streams, what is the best way to get as much cash value into the policy as possible? Is it a paid age 90? Is it a paid age 100 if there was such a product, which there are? Is it a paid age 65? Or is it a single premium dump in? A single premium life policy. It's a single premium life policy, right? It's one big massive premium where the cash value would probably start something like right there, and then it'd look like that over the life of the policy. But what's the problem with that big single premium dump in? You see, because there's a problem here that is not had here if you were to otherwise have a premium stream to age 90. And the problem here is this thing called TEFRA, DEFRA, and TAMRA, the fact that it's a modified endowment contract. And in most cases, we don't want a modified endowment contract for our clients. We like those tax benefits. A modified endowment contract to the clients is like an annuity policy, right? Last in, first out, except for the death benefit. A beneficiary doesn't care if it's a MEC. Now, this policy, let's say that this policy, forget all this other stuff here, let's say that the policy is a pay to age 90 policy. Is there a way that the client can cram, forget all these other lines here, is there a way, I'm going to keep the single premium line actually, but I'm going to get rid of the rest except for the pay to age 90. So let's say the structure of this policy is a pay to age 90. Is there a way that we can basically have the policy treated as if it was on a more accelerated premium structure than a pay to age 90? Why? Because again, this accelerated premium structure, look at what that does to the cash value versus the pay to age 90. So is there a way where we can get that product, the cash value in the product, treated as if it was somewhere between there and there? Is there a way? The answer is yes. Heck yes, it is. How is that? Do you know that a paid up additions rider, what a paid up additions rider is it is just a miniature single premium whole life policy. It's a miniature single premium whole life policy. So what you are able to do is you are able to say, okay, so I have $1,000 of premium coming in. I have $1,000 of premium coming in. I want to allocate a certain percentage of that premium, year 1, year 2, year 3, year 4, to a paid up additions rider. And I'm going to demonstrate a paid up additions rider here. Let me ask you a question. Can one say, I want all of my $1,000 premium going in as a paid up additions rider? No, you can't do that. You don't want that. Why? Because again, a paid up additions rider is basically death benefit and then one big single premium going in, elevated cash value. It would be a modified endowment contract, right? So the question is between here and the lower cash value, you know, the lower cash value that's generated if you were otherwise to pay to age 90, what is that proper balance? The proper balance is, I don't know what the heck the proper balance is. The illustration software pretty much always tells you what the proper balance is. And usually it's like 60%. For an age 45-year-old, it's usually around 60% paid up additions rider. And that will get you to ride that modified endowment contract line, right? Now, let's say you have a death benefit. So this is the base policy's death benefit. So that base policy's death benefit is that based off of pay to age 90. And this is what the cash value is going to look like on that base, on the base policy, right? Premium year one. Premium year one is going to look something like that down there from a cash value standpoint. But because we may get, say, 60% paid up additions in that first year, the death benefit may actually look something like this. So that first year's premium is a miniature single premium life product on top of that. Year two, you have another miniature single premium life product, right? And that's what that looks like. Year three, you have another miniature single premium whole life product, and it looks like that. And what you have is, if you were to blend the cash value out over the life of the policy, you have a bigger trajectory than if you just had this over the life of the policy. And you also have an increasing death benefit on that whole life insurance policy. There are things that are kind of reminiscent here to whole life or to IUL, right? Again, you're dealing with the same concepts here. It's just that you're dealing with different ingredients to the pie. And yes, whole life insurance is a little more rigid than index universal life insurance, but why is that? It's only because whole life insurance has guarantees that IUL do not have. But you know I love IUL. Why? Because of the upside potential. I hope that makes sense. These little slivers of single premium life insurance, what those are is those are paid up additions. And when those single premium life components are blended in with a pay to age 90, what you're able to do is you're able to ride that MEC guideline, right? Hope that makes sense. Charlie Gipple here with CG Financial Group. Shoot me an email if you have any questions, comments, concerns. Have a good day.